Last week, one deleted post wiped $23 billion off Palantir's market cap in a single afternoon. This week, Cathie Wood spent $11 million buying every share she could get her hands on. Trump went on Truth Social and called Palantir a proven war-fighting technology, and the stock is already bouncing off the exact support level that technical traders were watching. So, which side is right? Is Burry onto something real? Or did he just hand long-term investors the entry they have been waiting for? By the end of this video, you are going to know exactly what Burry got wrong, what the actual numbers say about Palantir's business, and the specific price levels where the risk-reward starts getting genuinely interesting. Let us start with the bear case, because you need to understand it before you can dismiss it. Michael Burry is not a random voice on the internet. This is the man who shorted the entire U.S. housing market in 2008 and made a fortune when everyone else got wiped out. When he talks, markets move. Last week, he posted that Anthropic is eating Palantir's lunch. The stock dropped 7% in hours. Then he deleted the post. But the damage was done, and a $23 billion question was left hanging in the air. His argument was this: Anthropic's annual recurring revenue exploded from $9 billion to $30 billion in just months. Businesses are pivoting toward easier, cheaper, more intuitive AI. And his sharpest line before he deleted it, it took Palantir 20 years to reach $5 billion in revenue. Anthropic did 6 times that in months. On a surface, that sounds devastating. But here is what most people completely missed. Anthropic is currently banned by the Pentagon. A federal court just refused to lift that ban after Anthropic declined to relax their AI safety guardrails for military use. Now think about that for a second. Palantir's single largest customer is the United States government. The U.S. military is literally using Palantir's Maven smart system right now to identify targets in the Middle East conflict. So the question is not whether Anthropic is growing fast. It clearly is. The question is whether it can actually replace Palantir where Palantir makes most of its money. And the answer right now is no. Wedbush analyst Dan Ives called Burry's take a fictional narrative and kept his $230 price target. And here is his core argument explained simply. Think of every large organization, a hospital, a government agency, a bank, as a giant messy pile of data. Patient records in one system, financial data in another, security logs somewhere else, none of it talking to each other. Palantir comes in and builds the connective tissue between all of it. They translate that chaos into a single operating system that lets AI actually work safely inside those walls. That process takes months of deep integration. It is baked into the organization's DNA. Anthropic sells a brilliant AI brain. But a brain without a nervous system cannot run a body. Palantir is the nervous system. That is why deep integration is nearly impossible to rip out once it is in place. And that is not something you replace with an API, no matter how powerful. But even if the business is untouchable, is the stock actually worth owning at this price? Because that is a completely separate question. Let us look at what the numbers actually say. In the fourth quarter of 2025, Palantir's U.S. government revenue grew 66% year over year. U.S. commercial revenue grew 137%. Total revenue hit $1.4 billion, up 70% year over year. And for full year 2026, they are guiding to over $7 billion in revenue, up from $4.4 billion in 2025. But here is the metric that tells you the real story about durability: net dollar retention. This measures how much more existing customers spend each year. Anything above 120% is considered elite. Palantir is sitting at 139%. Think about what that means. Even if Palantir signed 0 new customers for the rest of 2026, their revenue from existing clients would still grow nearly 40%. Once a government agency or enterprise company integrates their platform, they don't just stay, they expand. That is not a consulting business. That is a lock-in. And here is something the bears consistently ignore. Palantir is sitting on $7.2 billion in cash with 0 debt. In a high interest rate environment, they are earning $300 million a year just on the interest from that cash pile. That is a financial floor most tech companies would kill for. It means they don't need to raise money, they don't need to cut growth initiatives, and they can outlast any downturn that shakes out the weaker players. Now, here is the fair criticism, and I'm not going to hide from it. At a trailing PE ratio of over 200 and a forward PE of around 97, this stock is priced for absolute perfection. There is no margin for error, which is exactly why a single deleted post from Burry can wipe $23 billion off the market cap in a single session. When you pay a premium multiple, sentiment is your biggest risk. Does the growth justify the multiple? The Rule of 40 score gives you the answer. A score of 40 is considered excellent in enterprise software. Palantir's current score is 127. That means the market is paying a premium because the underlying business is delivering premium growth and premium profitability simultaneously. That is rare, genuinely rare. Let us talk about the chart, because the fundamentals tell you what to buy and the technicals tell you when. Palantir peaked at $207 in November 2025. It is now pulled back nearly 40% to around $128. That is not a minor correction. That is a violent reset driven almost entirely by sentiment, not business performance. Here is what the technical picture looks like right now. The RSI is entering oversold territory, which historically signals exhaustion of selling pressure. We are currently approaching the 0.618 Fibonacci retracement level on the weekly chart, which is the most watched support level by institutional traders, simply because enough people are watching it that it tends to hold. I like this level right now, and I've already bought some here. If this level holds, the setup becomes compelling for a long-term entry or a nice swing trade. If it breaks, the next levels I'm watching are the weekly 100 moving average and the 0.786 Fibonacci level below that. Those are the zones where the risk-reward starts getting genuinely interesting, and there's where I'll fire my second bullet for a rebuy. One more catalyst worth noting. Earnings are on May 4th. If Palantir delivers another quarter of triple-digit commercial growth, the narrative flips overnight. So here's where we land. Burry is not wrong that Anthropic is growing fast. He is wrong that it threatens Palantir's core business in the near term. The Pentagon blacklist alone makes that argument fall apart. Ives is not wrong that the fundamentals are exceptional. He may be too aggressive on the $230 price target, given the macro environment and the valuation multiple risk. But the direction is right. Personally, I like Palantir a lot at these levels. Yes, you are paying a premium. You are always going to pay a premium for a business this good. But a 40% drawdown on a company with triple-digit growth, zero debt, and $7 billion in cash is not a warning sign. That is a gift from the market wrapped in fear. This is a generational business going through a sentiment-driven reset. The fundamentals haven't changed. The price has. And for a long-term investor who understands what they own, that gap between price and value is exactly what patience is for. If this breakdown helped you think more clearly about Palantir, drop a comment below and let me know where you think this stock goes from here. I appreciate you watching. If you like the content, please consider subscribing, and I'll see you in the next one.